Inflation and interest rates are two important concepts in economics. They both impact our lives as consumers, but they don't always work the way we expect them to. In this video, we'll look at how inflation and interest rates are different and why they matter to us. What is inflation? Inflation is a sustained increase in the general level of prices of goods and services in an economy over a period of time. It's measured by the Consumer Price Index, CPI, which measures how much more it costs to buy certain products today compared with last year. Inflation can be good, bad, or neutral depending on what causes it. For example, if you're living in an emerging market country with high inflation rates, but low interest rates that are likely to decrease even further. This may be a good thing for you because your money will grow quickly as its value erodes faster than other currencies, without losing purchasing power due to rising prices. However, if you're living in the United States where inflation has been relatively low ever since 2008, but interest rates have risen significantly over that same period of time. This happened especially on credit cards. Then, this could cause trouble for consumers who are already struggling financially due to stagnant wages. What are interest rates? Interest rates are the cost of borrowing money. They are set by the Federal Reserve, which is an independent branch of the U.S. government that regulates the country's currency and monetary policy. Interest rates can also be set by market forces. However, this is often not the case due to factors such as inflation and deflation, both discussed below. The Federal Reserve sets interest rates to ensure that economic activity remains steady without causing inflation or deflation, a situation where prices for goods and services go up or down significantly over time, causing instability in a given economy. The interest rate you pay on loans will vary based on who your lender is and what type of loan it is. Credit cards tend to have higher interest rates than mortgages because credit card lenders face greater risks than mortgage lenders when dealing with borrowers who don't pay their bills on time. How does inflation affect interest rates? As inflation rises, the cost of goods and services increases. Inflation is a general increase in prices for goods and services. When the purchasing power of your dollar decreases, it becomes more expensive to pay back loans, like mortgages, because you're making less money. If inflation goes up, interest rates will also go up. Increasing interest rates make it more expensive for people to borrow money and invest in financial assets, like stocks or bonds, the primary way people invest. As a result, investors can afford to bid higher prices for these assets because they have more money available to them through their investment portfolios or personal savings accounts. Why does inflation go up when interest rates are low? The simple answer to this question is that low interest rates are a sign of a weak economy. And when the economy is weak, consumers tend to spend less. When consumers spend less, businesses make fewer goods and services available for sale. Since we live in a system where people can only buy things if other people provide them with those things through production. This means there will be too many goods on the market compared to how much money people want to spend on them. The solution? Consumers borrow money from banks so they can continue buying stuff even though they're not earning enough wages by working at their jobs. Businesses increase production and hiring to spike slow sales because their costs go down, and governments inject new currency into circulation via taxes or printing press, all of which creates inflation. Now that you've watched this video this far, subscribe and leave a comment saying I subscribed, and I will personally reply to your comment. Now back to the video. What's the difference between monetary policy and fiscal policy? Monetary policy is the setting of interest rates by a central bank. This can be done through open market operations, where the central bank buys and sells government securities in order to change the money supply. The Federal Reserve uses this method to control inflation and ensure that there's enough money in circulation to facilitate economic growth. Fiscal policy is what it sounds like, how governments choose to tax and spend their income as a whole, rather than just at the federal level. For example, California has its own state government that can make decisions about taxes, spending priorities, etc., which are different from those made by Washington, D.C.'s Congress or Treasury Department. What is an inverted yield curve? An inverted yield curve is when short-term interest rates are higher than long-term interest rates. This typically happens when there's more demand for shorter-term bonds and less demand for longer-term bonds. It's possible that an inverted yield curve can forecast economic growth and inflation. In other words, if the yield curve is in inversion, short-term rates are higher than long-term. It could be a sign that inflation is coming soon, or at least after a few quarters of this trend continuing. Which approach is better, easing monetary or fiscal policy? There are two main approaches to monetary policy. The first is called the tightening approach, in which interest rates are raised and lowered in order to control inflation. The second is called the easing approach, in which interest rates are lowered or kept steady without worrying too much about inflation. The tightening approach has been used more often than not throughout history, but both approaches have their pros and cons, and they aren't always compatible with each other either. For example, if you want to lower your country's unemployment rate by raising interest rates so that people don't borrow money as much because it costs more, that could cause problems for people who already have loans from banks but can't afford higher payments on those loans. So this means raising rates might not be worth it if you're only thinking about reducing unemployment. However, if your goal is also reducing inflation, then raising rates would be helpful since high inflation usually goes hand in hand with increased borrowing activity by consumers looking at get ahead financially during periods of economic growth. Conclusion: this video has covered the difference between inflation and interest rates. Interest rates are charged for borrowing money, whereas inflation refers to the increase in general price levels over time. Inflation occurs when there is too much money chasing too few goods or services, which leads to higher prices. Interest rates are a monetary policy tool used by central banks to control inflation, as well as economic growth and unemployment levels by changing the supply of credit available in an economy. And that's it for this video. Thanks for watching.